Good evening, everyone. I'm Yael Hungerford, the Deputy Director of the Adam Smith Society, and it is my honor to welcome you to tonight's debate on the fiscal response to the pandemic, hosted by our chapters at the University of Michigan's Ross School of Business and Washington University's Olin Business School. Tonight's event is a good example of the kinds of thoughtful debate and discussion around the economic, social, and moral benefits of capitalism that the Adam Smith Society promotes. You can find information about future events and join or renew at adamsmithsociety.com. I am pleased to now hand things over to chapter leaders from our host chapters, Sean Kelleher from Michigan Ross, and Dolapo Ajudiku from WashU Olin.
Thank you, Yael. Hi, everyone. My name is Sean Kelleher, and I'm president of the University of Michigan Ross chapter of the Adam Smith Society. To introduce our first debater, Betsey Stevenson is a labor economist and professor of public policy and economics at the University of Michigan. She served as a member of the Council of Economic Advisors and as a chief economist in the Labor Department in the Obama administration. Professor Stevenson's research explores women's labor market experiences, the economic forces shaping the modern family, and how these labor market experiences and economic forces on the family influence each other. I'll hand it over to Dolapo.
Thanks, Sean. My name is Dolapo Ajudiku. I'm the co-president of the Adam Smith chapter of Washington University in St. Louis, Olin Business School. And I will introduce Casey Mulligan and Allison Schrager. Casey is a professor in economics at the University of Chicago, served as chief economist for a Council of Economic Advisors in the Trump administration. Professor Mulligan's research covers capital and labor taxation, the gender wage gap, health economics, social security, voting, and the economics of aging. Our moderator this evening is Allison Schrager, an economist and senior fellow at the Manhattan Institute and co-founder of Life Cycle Finance Partners, a risk advisory firm. Allison has worked in finance, policy, and media. She's a regular contributor to The Economist, Reuters, Bloomberg Businessweek, and is the author of An Economics Walks into a Brothel. Without further ado, I'll turn it over to Allison.
Welcome. I'm so glad. I can't imagine two better people to sort of hash out where we are and where we're going. So I'm just going to jump right in and ask each of you to assess what the fiscal support packages we've had so far have achieved. Have they been enough? And sort of where we are now. So Professor Stevenson, do you want to kick us off?
Sure. So let me start by just saying that I was really impressed by how quickly Congress and the White House moved way back in March in terms of getting much needed fiscal support out to families. I think we saw just how important that was for supporting the economy. We saw jobs really fall off a cliff and unemployment rising in March and April at really unprecedented levels. And really that came to a halt in May, even though the pandemic was continuing to deepen. The sort of job loss, the spending declines that families were going through stopped and started to reverse because we got that financial support. So, I thought, economists always say that what we want is timely, as well as targeted and temporary, but timely is really important, and that timely response in March, I think, made a really big difference. Now, the thing is, what we've seen is that was just, the pandemic has gone on for a lot longer than we expected. And I think if there's a criticism for what Congress and the White House got wrong, was not containing the pandemic. And as a result, we've had ongoing economic hardship, which means that what we passed in March couldn't get us through a pandemic that continues in February 2021, which is why additional stimulus is needed at this point.
Casey, you have more to say? All right, Casey, do you want to weigh in?
I would agree. The timing was impressive and surprising. I'd say on both of those. When you're in a hurry, you can be sloppy, and it was quite sloppy. We saw. I think still we have record personal incomes, record highs above pandemic levels. So personal income is kind of overshot. Spending is not at record highs and not returned to pre-pandemic levels. So it was an overkill. But again, the timing was so good. Maybe you would forgive some sloppiness. I think, given that you're being sloppy, you don't want to have it run for a long time. You want to have time to clean it up and do something a little more targeted. I think the far and away the best piece of spending back in the spring was Operation Warp Speed. Cost about $10 billion. All this other stuff is in the trillions, and even though Dr. Fauci interrupted the president in public to say, "You're wrong, we're going to get a vaccine by the end of the year," no way. It takes over a year just for the government to approve it, Fauci said. New York Times has had a timeline running out, I believe, to 2020, 2030 something. But we got it by the end of the year, and the Warp Speed was a very well spent. I wish it had been quicker. Instead of the end of the year, I wish it had been the end of the summer. But it was better than the alternative, which was looking like would take years till a vaccine could be approved and given to the general public.
So you both sort of hinted at, I think, the hot question of the day, which is the $1.9 trillion package that's being debated now. How do you feel about that package? Do you think that amount is too much, too little, or are you okay with the number but have issues with how the money is spent? Betsey, what do you think?
Yeah, so I want to actually return to something that Casey said about record incomes. We have seen inequality in this pandemic absolutely explode. So he is right. Some people have had record incomes, while a lot of families are actually really struggling with lower incomes and greater expenses in trying to manage the pandemic. And so, I think the question with the 1.9 trillion is whether it's time to take back, some of the pandemic gains that we saw some big corporations get, right? Billionaires got richer than they've ever gotten before. Do we need a one-time tax to sort of say, like, you didn't deserve that, you didn't earn that, you benefited from the pandemic? I think that should be a separate debate, though, from whether or not families need the kind of spending that's in the $1.9 trillion package. What's in that package are things like supporting children through an expanded child expanded child tax credit, and then supporting child care through both an expanded child and dependence tax credit, as well as supporting actually child care centers, expanding the EITC. All of these things are around making sure that families in the bottom half of the income distribution and families in the middle class have what they need to be able to come out of this pandemic and be able to move us to a stronger economy. Look, we have seen record accumulation of savings in the very top end of the income distribution. And so I have no doubt that when the vaccine has been fully implemented, we're going to see a spending surge coming out of the top. The question is, where are we leaving the rest of the population? Are they able, we've seen record lines at food banks. That seems like not what we want in a pandemic. And so when you ask, like, what about the 1.9 trillion? Look, I think it's absolutely the case that the spending priorities in there, particularly to support schools, support states, and boost families at the bottom, are essential right now.
I'm just curious what you mean by billionaires who profited. Do you mean companies like Pharma or Amazon who profited from the pandemic economy, or profited from government programs that they didn't need?
Well, I actually was really thinking about Amazon, right? That was just a positive shock to a lot of tech firms, right? They, if you think about a lot of technology, they understood that it takes people a while to adopt technology. They were on a path to have greater market share in the next 5 years, and they got all that greater market share this year, and they took that market share from somebody else, so there was a transfer. Now, I'm all for that. That technology was coming, those transfers were coming, but when they come that quickly, it's pretty disruptive. And so then the question is, how do we help smooth that transition? Economists are not very good at talking about the things we need to do to smooth really disruptive transitions. you know, in some ways, the pandemic was like ripping a Band-Aid off when it comes to how technology is going to change our lives, but it hurts. And so we want to do a little bit to help folks out.
I think, Casey, I mean, what's your view on the package? And also, I mean, as Betsey points out, I'd like this conversation to go sort of longer term where we're going and sort of how this is going to transform the economy and what the role of government should be. Sorry, that's a bit of a loaded question, but.
Well, I agree that there are people who have suffered and are suffering in the present tense. You know, running through all these different government agencies is such an indirect way to get them the money, and there's so many snouts in the trough between here and there. I think for a lot less than 1.9 trillion, you could be sending money to low-income households, those who have low incomes for a long time, and those for whom low incomes is a new thing. There's a lot of special interests in there. Teachers unions getting something like $50,000 per teacher in this new bill, on top of all the money they already get from state and local governments, and they don't even have to agree to go into the schoolhouse and teach. So, you know, that's to be expected. You know, the special interests are partaking there, and that's always going to be the extra burden when you're trying to use government to solve social problems. You're going to have all these special interest riders on top of it who are going to make it more expensive to achieve the objective, and maybe make it impossible, maybe even make you go against your objective.
I see. So you're not opposed to the size, just how it's targeted?
No, I would get rid of 1.5 trillion of it and focus the 400 billion on the low income people, and that would be a lot of money per low income person. Mm-hmm. All these other spending. And that's why you see the stock market going up so much once they say, oh, the stimulus bill's coming along great, stock market up. I mean, it's because that money's not, that's not because you have the poor people in the food bank line all of a sudden clicking on Robinhood, buy me some S&P index. That's because the higher income people understand that they're getting a vast amount of anything that comes out of Washington. And we have to be realistic about that.
I disagree with that characterization of why the stock market reacts positively to further government spending and greater fiscal stimulus. What companies want to know is that people are going to be able to buy their stuff, and that we're going to be in a strong economy. And so when they see a lot of government spending, it's not that spending is going directly to those companies. It's that they think that the economy is going to be stronger, and a stronger economy does mean more money for the bottom line for a lot of companies. I think the thing is, Casey just pointed to exactly what the problem is. Is 1.9 the right number? I don't know, but I think 400 is too little. And what happens in Congress is you got hundreds of policymakers that are going to have to debate on what is the exact right number. It's not like economists are going to, come in there and run our models and figure out exactly what is needed to get the economy back to its potential as quickly as possible. I'd love it if that's what would happen, but that's not how our politics work. What I do know is that when we do too little, we can get stuck in a really drawn out long recession. And when we're in a really drawn out long recession, we end up losing skills, making it so that people are more disconnected from the workplace, making it even harder to come back. And I think in hindsight, we all know we did too little in the 2008 recession. And we did too little because of data problems. We didn't know how bad the economy was. So we proposed something that we thought would get us back to potential. It was way too little to get us back to potential. And then we saw this drawn out recovery. I think what we want to do now is admit that there's a little bit of uncertainty and ambiguity about exactly where potential is. And the risk of doing too little is greater than the risk of doing too much.
I totally agree with helping low-income people, totally agree with it. But there's an equity efficiency trade-off. And I don't agree with selling to people this idea, if we resplit the pie more fairly, actually the pie is going to get bigger quicker. It's the opposite. The reason we're going to have a long drawn out recession from this is because it's resplitting the pie, and the pie will be smaller, and maybe it's worth it. The equity efficiency trade-off is about, hey, we're willing to make the pie smaller, but it is going to make the pie smaller. So when the pie is not growing like next year and the year after and the year after that, we shouldn't be scratching our heads wondering why. It's because we threw 1.9 trillion in this installment, probably is going to be multi-trillion installments coming after that to resplit the pie, and that's going to make it smaller. We're subsidizing layoffs, for example. The huge subsidy to layoffs in this package, and you're going to have more layoffs when you subsidize layoffs. We're subsidizing people staying out of work. You're going to have more people staying out of work when you subsidize that. And that's maybe okay to help people who need it, but it is a consequence. And I'm sorry to be the practitioner of the dismal science, but that's what we have.
How are we subsidizing layoffs?
When you fire somebody, number one, you may have an agreement to take care of their health insurance, but now the government's going to take care of that. So this is an opportune time. And companies said this in the 2009 stimulus as well. They said this is the opportune time to let people go because we don't have to pay for their health insurance. They're going to get unemployment benefits, and unemployment benefits, a fraction of them, not all of them, are charged back to the employer who made the layoff. But these unemployment benefits in this federal package are not chargeable to the employer. So it's an opportune time for layoffs, and not an opportune time to sign up for a new job and come off the sidelines into the workforce. I mean, many people, as we know, CBO and others have calculated, people are majority of the unemployed make more from these government benefits than they would from accepting a position like they had before, let alone a lower wage position.
Okay, so
now that's not to say that everyone will decide not to work. Mm-hmm. But even if you have 5% of the people deciding not to work because of these terrible incentives, or 5% of the hires don't happen because of these terrible incentives, or you get 5% extra layoffs because of the terrible incentives, that's a recession in and of itself.
Yeah, so I think though 5% is an absurd number in terms of disincentives. So a couple of responses. One is, if companies say, gosh, I've been carrying this person and they're not efficient and I'm losing money from them, and this is an opportune time to let them go, that's okay. I mean, that's in fact what we want to see, is companies becoming as efficient as possible to be able to recover from this, and then we build back stronger. So I'm not worried that companies use an opportunity to get rid of someone that they would have gotten rid of in a couple months anyhow. If we look at people who had a disincentive to work, when we were looking at $600 a week checks on top of the unemployment insurance checks people were getting, there was a small portion of the population, not a huge portion. That's why I think 5% is absurd, is that the whole idea is that most people receive a tiny, tiny amount relative to their paycheck. So even someone like my nanny, when I had to lay her off based on state policies that we all had to stay home, and she went on unemployment insurance, her unemployment insurance check plus the $600 did not come anywhere near her paycheck. So it's not that most workers were being paid to stay home. There are some, but they also know that the risk of staying out of the labor market is great. So even among those who are better off being on unemployment insurance, I've been surprised to see them making a real effort to get back into work because they're afraid of being shut out. I believe in an equity. I believe that we can't just keep cutting up the pie and necessarily make it bigger. But I mean, let's start with one place where we already saw cutting up the pie, not making it any bigger, and that was with the Tax Cut and Jobs Act. We reallocated slices towards corporate America. We didn't get a bigger pie as a result. We got a less fair society and no bigger pie. So at least let's start making the slices fairer for everybody. Even if the pie were to stay the same, I think we're better off.
What was the unemployment rate last February?
On exactly the trajectory it had been on since we started recovering.
Betsey,
so there's no benefit that came. Every study has shown there was no benefit that came out of the Tax Cut and Jobs Act for workers.
If you look at the forecast that you made when you were at CEA for unemployment, you never said it was going to keep on going and hit 3%. You never said that. We were supposedly incapable of growth, secular stagnation and that sort of thing.
And we saw the kind of rate rates of secular stagnation that were projected. We did not unleash some fury of growth coming out of that. And I do think when we invest in early childhood education, when we invest in people, we can actually grow the pie bigger. It just takes some time. It's not going to happen overnight. But what we saw with the Tax Cut and Jobs Act was that what was holding corporations back from investing was not high tax rates. It was that they just didn't have places to put their money. There weren't that many projects on the margin. And that's the reality, is that yes, tax rates can matter when there are a bunch of projects on the margin, and there just weren't that many.
Casey, do you want to defend? I mean, I guess it does speak to sort of how we're going to cover where we were pre-pandemic about the Trump economic policies going in. Do you think that
this is always the claim that's made? There's nothing's on the margin. There's a whole bunch of projects that are awesome and a whole bunch of projects that are worthless, and everybody knows the difference between them, and there's nothing in between. So you make a change in incentives and nothing will happen. It's not true. It's belied by the fact how many businesses are coming in and going out all the time, how many businesses are on thin margins. It's very clear that there is real margins in the economy, and there always is, and always is in things. So that's part of the dismal science, I'm afraid. But there are things on the margin.
I believe that there can be lots of things on the margin. I'm not saying hypothetically. I'm saying that we didn't get what was predicted by the Tax Cut and Jobs Act. We didn't get what the Trump administration predicted. Where was the 3% real, 3, 4, 5% real growth that President Trump kept touting? It wasn't just around the corner. It wasn't coming. Okay. It just didn't do what you guys said it was going to do.
What you guys, okay, there's President Trump, who's great at marketing and great at a lot of things. And there's his economic team who have diplomas and training and stuff like that. If you look what we did in the economic report of the president and what we said was going to happen, and then what actually happened was very close in terms of the amount of investment we saw, the types of investment, because the tax changes, the heavy tax were on different type of assets. And so we were relaxing some assets more than others. All those things lined up. And we're not trying to take credit. I mean, we used the literature that was there before on the corporate tax, and we just updated those models and made predictions about what would happen, and those things came very close.
So we did see an increase in investment?
Yes, especially the types of investment that would benefit from a corporate tax cut.
Like what?
If you want me to disconnect my headphones, I'll go get the economic report of the president.
Okay, well, I'll just...
It's in the chapter 1 of the economic report of the president, 2020, 2019, both of them right there in the front. You don't have to dig deep into it.
Okay. Well, you also said something earlier about how the current bill is about, the pie and reshuffling the pie. And I have a wonder, are we reshuffling the pie with the new stimulus? Because, who's paying for it? If you redivide the pie, you have some people giving up and some people taking more. Is anyone really giving anything up in this latest stimulus, or are we just, or other than, I guess, maybe future generations? Who's paying for it? And does that matter?
Well, somebody's going to be lending the government money instead of spending it on themselves.
Well, or the Fed. They're buying a lot of the bonds.
Well, okay, well then anybody who owns bonds is going to, or has money, or anyone who's on a fixed income, those are the people who will pay. If you think the Fed's doing, I'm not one of these who thinks there's massive inflation coming. You can borrow against future generations without having any inflation. You can borrow against future generations in an economy with no money whatsoever, and there's by definition no inflation. So those, I think, are quite separate issues, but that people are still paying for it.
Mm-hmm. Well, I think the tricky thing is that the best way to deal with government debt is through economic growth. And so then the question is, how much of additional stimulus spending do you think is necessary to catapult faster economic growth out of this recession? And that will ultimately determine who pays for it and how much there is to be paid for, right? So if we end up with we're producing less stuff and we end up with slower growth, we're sort of stuck in a recession, then that in and of itself is really bad. And so I think that's one way to think about it. And then the United States like most countries, we don't really distinguish between spending on consumption by the government and spending on investment. And I kind of wish we did, because when we spend on investment, it's going to end up, yielding returns in the future that may, it's not magic when I say it could pay for itself. It's just that it's an investment with a stream of returns. And it's possible that the net present value of that investment is high enough that it's something that taxpayers would want to do. And we've seen that with early childhood education. The net present value of the returns to greater spending on childhood education is positive, so we should do it. And it's not going to even necessarily cost the future generations down the line. I will say there's a lot of things I really believe in, which is redistribution towards people and the bottom part of the income distribution. And we can't claim the same kind of investment returns there. So we do have to start, or we can think about health insurance, where we spend on healthcare, and healthcare is consumption. I think Casey, you keep liking to say that's the dismal science. That's the dismal science. Some of what we do is consumption. Some of what we do is investment, and we don't do a very good job about thinking about where our government dollars are going.
So I have time for one more question before I'm going to open it up. But sort of following up on that, and something you said earlier about your concern that we've sort of sped up a very sort of a structural change we're already doing towards more technology, which is going to disproportionately hurt some jobs more than others, probably low-skilled jobs. And you also said that there's a risk to not doing enough for those people. Do you think the current stimulus package is addressing potential structural unemployment? And if not, what would you like to see that would?
So I think that we did see a speeding up. I think we'll never see as many people working in retail post-pandemic as we saw pre-pandemic. That is, people all over the country who maybe never thought they were going to online shop, now to some online shopping. I think a lot of people are excited to go back into stores, but the shift away from Main Street retail, away from malls, is going to be real. I do think that we're going to have to think about what's the right way to fund increased college, because we are in a world where our workers need more skills, more community college, more vocational training, and there's not going to be as many jobs where you can do it without some very specific training, right? So it's not to say that those other jobs were unskilled, but you came at them without any sort of formal skill, apprenticeships, vocational training. And I think that we need to approach things a little bit differently. And I'll tell you that, in Australia, I was just talking with a guy who trains high school students to be baristas. And I was sort of confused about this, because in the United States, I think even Starbucks uses the press a button type coffee machine. But what they do here is every job is approached with what kind of training do you have to do that? And I think that we need to take that approach in the United States, and we haven't really expanded our job training as much as we're going to need to.
Casey, do you think fiscal policy has a role in sort of dealing with these structural changes? If so, what?
I would say that, first of all, that in a lot of things that do no harm, we economists don't have to take that oath, but we ought to. And something like the $15 minimum wage is going to accelerate these type of changes. That's just saying, screaming, bring on the robots. And things like that in this bill are going to accelerate a transition that maybe is going to happen someday, but it's going to happen sooner.
Do you think
so?
Go ahead.
Alice, I was just going to say, I don't know the answer to this, and I don't know if Casey does either. But I'm going to give Australia again as an example. Minimum wage $20, and the baristas are all making coffee by hand, and they aren't using any sort of automated machines. the United States minimum wage $7.25, and all these companies are coffee companies adopt the machines where the person just pushes a button. Why? I don't know that minimum wage is playing that big of a role in the decision to adopt technology or not adopt technology. Now, Casey, it may be some other government policies or regulations that I'm not thinking of, but it feels like minimum wage is not the big factor here.
All right. Do you want to have the last word, Casey, before we go to questions, or should we go for it?
Let's go for questions, please.
Okay. So Sean, because you're president, you can kick us off.
Sure. Betsey, Casey, and Allison, thank you very much. Super interesting. And a question I had on my mind, I think it was discussed a bit, or some of the impacts towards the end of the talk there, is thinking about the extent of the COVID relief dollars that have both been spent or are being planned or debated spending. How do you think that impacts, or will it have an impact on other Biden administration goals and some of the things we've talked about related to student loan relief, the $15 minimum wage, or a lot of the other possibilities or promises that were discussed during the election? And given everything that we're discussing related to small businesses and families still struggling, the need to kind of smooth the transition back to a normal economy, how do you see some of those administration goals or possibilities change or impact by what the spending and relief has been?
Yeah, it's kind of a political question. It's not my forte. Washington will probably continue to surprise me.
I think that's a great answer, that Washington continues to surprise. So it's sort of, hard to know. Student loan relief is really challenging because there's a lot of inequality among students. Some students who have enormous loan debt that they're taking on, and other students who've had the help of friends and family. But at the end of the day, people with those degrees are better off than people without degrees. And so I think that is a real challenge in terms of thinking about how you manage student loan relief. One of the things we found in the Obama administration was that the real problems managing student loans come from people with very small amounts of loans, but they didn't get any kind of degree. They might have gone to a for-profit that didn't really teach them anything. They may have, it really is people coming out of these programs where they didn't get any real marketable skills. So now they're coming out at minimum wage and they owe $2,000, and that's impossible, right? And so, Sean, you're at Ross, and that might be hard. I hope that $2,000 is going to be like really trivial for you to pay when you graduate. But if you come out and you're making $8 an hour, you don't have a lot of marketable skills, it's impossible. And I think we really have to handle these folks who really did not get what we should consider a college degree, and we shouldn't be mixing those up with somebody who graduates from the prestigious Michigan Ross School with an MBA and maybe an undergraduate degree from somewhere else, and they've got a bunch of debt, but they're also coming in, looking at getting that six-figure salary in their very near future. Those are very different types of people. In terms of the $15 minimum wage, look, one thing to notice is that they've been talking about that for a long time, and every day it becomes worth just a tiny bit less because of inflation. So even when they're talking about the $15 minimum wage right now, it's not $15 for 2021. And what's really clear is that $7.25 is now absurdly low. I think the real debate on the $15 minimum wage, it's going to stay 15, but the question is going to be, is it in 2025? Is it in 2028? Is it in 2030? All that's going to impact what economists care about, which is the real value. How much stuff does it buy, and what does it compare to, in inflation-adjusted terms, to the kinds of minimum wages we've had in the past?
Okay, Dolapo, You have a question?
Yes. I think that's probably Betsey that might have touched a little bit about this, but in thinking about like the potential long-term implications from being out of the workforce for a while, how feasible do you think it would be if we're looking in a few years from now to specifically measure that and trace that due to the effect of the pandemic? So really just thinking like what are some of the long-term implications of that, and would we be able to accurately measure that in the future and get a root cause to COVID?
Yeah, so I'm certain there's going to be tons of scholars who are taking a look at this, and we look at it in different ways. So you might want to say, what happened to the generation that graduated in the pandemic? How did that affect their trajectory of earnings? You might want to look at, I'm particularly interested in moms with young kids. So what you would want to do is think about, moms with young kids and compare them to sort of cohort of people who had kids maybe a couple years after the pandemic started and say, like, what was the real difference there? You might want to look for differences across state lines. And that's sort of the way in which people try to tease out what are the causal effects of a pandemic, is you want to look and see, is there any kind of natural variation that might allow me to isolate the effect of the pandemic on this particular group? We'll never get a really good aggregate number, but we might be able to get some really good estimates for particular groups of people in terms of how the pandemic affected, affected their sort of long-term prospects. I think one of the things that's always hard whenever we see job loss is we see that those people who experience job loss have worse outcomes, but we also do know that job loss isn't completely random. And so we have to think about who loses their job and how they might be different from the people who keep their job and try to make adjustments along those lines. And so what we want to look for in the data is that random component that might allow us to isolate what was the effect of the pandemic.
If you look at the website, I have right there, I try to look at the cost of the pandemic, and I agree with you that the human capital costs are important. I don't know that it's as hard. What's interesting about any kind of capital problem, you have the investment up front, and then you have the returns on the back end. And if we had perfect foresight, you could use either one. You wouldn't need one or the other. You just need one of them. And so what I measure in this website is what are the inputs that aren't going into human capital, school-age children and young adults, but also people earlier in their career I look at as well. I forget about the relative size of the components. It's something like 2 or 3 billion per working day that we have a pandemic and kids aren't in school and young people aren't launching their careers. That's the lost input. Now, what's going to be the lost output? Well, in present value, I'd say about 2 or 3 billion. I mean, one thing that you can say for this 2 or 3 billion is people were making those investments with a lot of times with their own money and especially their own time. So they thought it was going to have a good return. Now, it's possible that they were foolish and it was going to have a terrible return, and it's a good thing the pandemic stopped them from making that investment. But like I said, you can measure the inputs and start to get at some costs here.
So I have a question. Sorry, that is, go ahead.
Go ahead, Allison.
That I'm sure is top of mind of a lot of people in the audience, which is like work by people like Tilvan Watcher has found that graduating during a recession impacts your earnings for 10, 15 years. I mean, this is a very different kind of recession. Should new graduates be worried about the labor market they're going into?
I do think this is a very different kind of recession, but I don't know yet how this is going really to impact hiring of young people. In some ways, they're more willing to do work that other people aren't willing to do. They're usually the most sort of disposable. But now, we sort of need them because we feel like, they're at sort of less risk. But at the same time, we're about to enter a time period where we're going to have, the top half of the age distribution vaccinated and the bottom half of the age distribution not vaccinated. So that might turn things. So I think that question's really hard to answer. I mean, look, on the pandemic costs, I think the thing that is going to be really difficult and take years for us to sort out is what's the cost of the pandemic and what's the cost of government response or non-response, right? So you can look at countries like New Zealand or Australia that decided that they were going to end the pandemic and not have COVID. And what happens in their economy. It's not free for them to have done that. Then you can look at what happens in an economy like the United States, where we did a lot to just let the pandemic run its course. The pandemic has hurt us all. I think all of us will be in agreement there. And government did some things that were helpful and some things that weren't helpful, and sorting out which was which, I think that's where the debate will go on and maybe never be resolved.
All right. So we also have a question from Jonathan. Jonathan, I might say your name incorrectly. I apologize. Deludi?
No, you got it. You nailed it.
Right.
Just my question's about sort of the change in monetary policy that, or the changes in monetary policy that we've seen over the last few years, particularly with the sort of, I don't know if unprecedented, but highly unusual steps the Fed took at the beginning of the pandemic. And so, there's been a lot of talk about the degrading of the separation between fiscal and monetary policy and the monetization of the debt. So the Secretary of Treasury, Janet Yellen, obviously was chair of the Fed. Do you see her as a figure who is there to merge the Fed and Treasury beyond what we're used to seeing in America, or maybe as someone who, given her past, understands better than anyone else the need to keep those two things separate?
I don't pay much attention to the Fed. I'm not a bond trader. If I did, I would pay a heck of a lot of attention. In terms of what the Fed does for regular people, there's 100 things higher in the list. So, and I never got past those first 100 to think about the Fed. So I'm sorry, I got almost no expertise on that.
So I think we saw the Fed develop a new set of tools and really change its approach to monetary policy. Really starting at the beginning of the 21st century, and then that was actually sped up with the 2008 recession. There was some changes going underway about like paying interest on excess reserves as a monetary policy tool that was sort of being debated and considered. And then it was like, whoa, we got a crisis, let's get this going. You all know about the sort of extraordinary measures trying to affect long-term rates. They had built this toolkit in response to the 2008 recession. I don't think anything they did in response to the pandemic was unusual. It was just that they pulled that toolkit out super fast. And I think what surprised people was we were hearing, oh, there's no pandemic in the United States, everything is fine. And the Fed is like, woo, we're doing all this stuff. So it turned out the Fed had probably a better sense that the pandemic was coming than I think a lot of people did. Like, I was sort of looking at what the Fed was doing and being like, should I be more worried? Maybe they got lucky. They anticipated it. Maybe they had some information that the public didn't have. But what they did was pull out that 2008 toolkit very quickly. Now, I am not going to speak for Janet Yellen. Janet Yellen speaks for Janet Yellen. But what I will say is that it's really important that monetary policy and the central bank remain independent from any kind of political influence. And that's, I think, the most important separation between monetary and fiscal policy, is that we need central bank independence. And I think that Janet Yellen, in having to address a lot of, I think, really misgotten attempts to have Congress control, say, interest rate policy, means that she is probably more sensitive than most Treasury secretaries to the ways in which intermingling monetary and fiscal policy, or Treasury and the Fed, could increase the likelihood that we would lose central bank independence in the United States. And I think that would be a grave risk to our, I think just a grave risk to the economy. And so I do trust her, again, I'm not speaking for her, but I do trust her to prioritize in the need to maintain Fed independence.
Kind of following up on that, in that spirit, we have a question about inflation from Andrew Freeman.
Thanks, Allison. Really great conversation so far. So inflation has been discussed recently in news articles. It's coming up again. And in terms of concerns about possible inflation going forward due to the massive fiscal spending that we're entertaining. After the 2008 crisis, we really didn't see much in the way of consumer price inflation, but we did see a rise in asset prices, what I would say like asset price inflation. I'm not sure if that's technically correct, but I'm curious if that's something that we should be concerned about in terms of discussions of fiscal stimulus and monetary policy. And as someone who'd like to own a house one day, I'm concerned that some of this policy is just propping up unsustainable asset prices. Here in California, you can get a one bedroom condo in some places for $1 million. So I don't think that this is necessarily sustainable, and I wonder if there should be possible changes to monetary and fiscal policy, or if this is just a necessary pill to get us through the crisis.
You know, something like buying a house compared to your salary. And I'm not sure inflation has a lot to do with that distinction. I think there would be things like regulations that would be much more important in terms of determining, for example, California, heavily regulated and very, very expensive housing. It's really not the housing that's expensive, it's the land it sits on. And Texas has a very different regulatory situation. And when people want houses, they just build more, and the prices never go up that much.
So I think this is a place where Casey and I share some agreement in that, I think all economists agree that when you constrain supply, housing prices go up. And in some of the worst markets, the problem we're seeing is policies that constrain supply. That's definitely, I think, a first order issue when it comes to some markets. Look, I don't think very low interest rates make it cheaper and easier to service a larger housing debt. And so I do think that low interest rates can help drive up housing prices, because when you or somebody else is going to buy a house, what you're going to think about is what's your monthly payment. Lower the interest rate, lower the monthly payment, the more you're willing to spend. And that has been some of what we're seeing going on in the United States. Now, the thing that worries me a lot, but is also constraining some of that, is that lenders have really tightened lending standards. So, you need a higher FICO score than you did before the pandemic. It is harder to get that loan. It's harder to get that refi. And those tightening credit standards mean that not everybody's jumping out there to buy that house, which means that we're not pushing up prices as much as we otherwise would. But again, if we think about distributional things, who gets access when lenders tighten credit standards versus who doesn't? And so I do worry about, a young person who wants to be able to buy a house, and they maybe don't have as much backing them as a more established person who decides they're going to buy a bigger house. And I think we already see some of that in the data, and that we see really wild demand at some of the top ends of the housing market right now as people are trading up because interest rates are so low.
Thank you.
We have another question from Federico.
Hi, thank you for the debate. This is really interesting. I have a question regarding to one of the points that the two of you touched, which has to do with what is enough regarding the response to the COVID. And I was doing some numbers here. Please feel free to jump in and correct me. So my question is about the order of magnitudes of like what the COVID pandemic cost so far. From a GDP point of view, I know there are a lot of other discussions regarding redistribution of wealth and the K recovery and all that. But in this case, like from my understanding, like the US economy shrank around 2.3% in 2020. That's like around, I don't know if I'm correct, 500 billion year-over-year loss versus the peak in Q4 2019. The peak there was 21.7 trillion. In Q4 2020, we sat at 21.5, or I think 21.2 maybe. Then I was just looking at the graph at the Federal Reserve, St. Louis, the gross domestic product. In Q2 2020, that's the worst moment so far of the pandemic. The GDP stood at around, I think, 19.5 trillion. So that's basically a 2.2 trillion reduction from its peak in output from Q4 2019. So, and then from my understanding also, fiscal response has been 2.7 trillion so far. That's the 2.2 from last year. And we have like the recent 500 billion or 600 billion. Let's keep it in 500 billion. So that's like 2.7. And then the Federal Reserve expanded its balance sheet by 3.2 trillion. So total response has been around, let's keep it rounded, 6 trillion or 5.9 trillion. While the damage at its most, by measure by GDP, of course, has been 2.2 trillion. So my question, going back to what you were talking before, and thank you for this, is like, couldn't this be a potential sign that the response has far outweighed the damage? Or what are we looking here, or what am I missing here that explains the response, like being like, just by using numbers, like almost triple? Thank you.
I mean, you're having, the pandemic made the pie smaller. We're not able to do things that we used to do. And all the things you mentioned in terms of policies, the GDP is the size of the pie. All the policies you mentioned are reshuffling. And again, I'm in favor of reshuffling the pie to help some people who are suffering. But you're just reslicing the pie. You're not making it bigger. And the way to make it bigger is get the pandemic over with. And when I was in the White House, actually in 2018, we wrote a report about pandemics and what to do. And when we said, number one thing, no one was paying attention to us at the time, number one thing, vaccine. Make the vaccine quick, distribute it quick. That everything else is a far, far second or third place. And so that's where all the attention should be. I mean, the vaccine locations should be open 24/7. That is far and away, to get the pie back to the size it was, it's far and away the best thing to do. And the rest is reshuffling it. And I'm not against reshuffling. If you're interested in other hobbies, go ahead, pursue those other hobbies. But if you're interested in the size of that pie, which is the GDP, just get the vaccine out there, and so we can have this pandemic behind us.
Federico, so Olivier Blanchard has a really nice column that walks through the numbers that you want to walk through. I'd say they're slightly different because you actually want to think about like the growth trajectory, and you also want to realize that January and February of 2020 were a period of growth. So when you put them into your average, you want to think about where the economy was in December 2020 relative to February 2020, not the average in 2020 compared to the average in 2019. This is a little bit nitpicking, but Olivier comes up with an output gap of 4.2%. So that's roughly twice what you've come up with for those reasons. Then I think I disagree with Casey that I do think that some of what you can do is actually fill the hole. There's some ways which are not going to fill the hole. I'm not going to get you out to a restaurant, sitting down, eating. People are voluntarily not doing that because they want to stay safe. But if you're not paying your rent because you can't afford it, if you're cutting back on groceries, if you've decided, you're not going to buy that car that you were planning to buy. I was literally in the market for a car when the pandemic hit, and I was like, I don't know what's happening. I feel risky. And because I feel risky, I pulled back. I didn't buy the car. So that whole thing shuffles through the economy. What we saw happen in March when they spent a lot of money was people started spending again by May. And that's where we can sort of fill in the hole. Now, I think you're right to say that 1.9 trillion may take up more than the whole. So there's two things for you to think about. One is we don't really know what potential GDP is. So is 4.2% the right number? Is it 5%? Is it 3%? What's the right number? We don't fully know. The second thing is this idea that people don't spend all the money you give them. So if I give you $1 and you say, oh, thank you, that's going to make me feel safer. I'm going to put it in my bank account. I'm going to pay off some debt. I'm going to do things to shore up my own financial situation. You didn't fill the hole. So only the dollars that get spent in the economy are filling the hole. So we need to know the multiplier effect. And if the multiplier is well below 1, then you actually need to spend more than the size of the hole. And so that's where the debate is. The debate is, how much more do we need to spend? Because how much did people save? And what we saw was on the first round of stimulus checks, people saved about a third of it. So that tells you something about that tells you something about why we might want to spend more than what's missing.
Thank you.
Or the multiplier could be negative. You're paying people not to work. You're paying companies to accelerate layoffs. That's work that would have been done, but for the incentives you have. So that's an example of a negative multiplier. And if you don't see the pie growing at the rate you want it to, I don't advise doubling down on negative multiplier projects. Negative multiplier projects, the only reason they make sense is for the fairness issue that we've talked about. But they're still, I hate to be the dismal economist, they are still negative multiplier.
All right, I'm getting cues that we have to wrap this up because we only have 30 seconds left of our allotted time. Sorry if we didn't get to your question. So I'll put over to Yael.
On behalf of the Adam Smith Society, I would like to thank Professor Mulligan and Professor Stevenson for tonight's spirited and thought-provoking conversation. And thank you, Allison Schrager, for your expert moderating this evening. Thank you to our host chapters and all of our members who tuned in to tonight's event. For more upcoming events and future learning opportunities, please visit adamsmithsociety.com. And have a great evening.